You're about to listen to the Yet Another Value podcast. Today's episode is episode number 314. We're having Doug Garber on. He's from a rival podcast, the Pitch the PM podcast, but that's okay. We're going to have a really interesting discussion about a very small company that has more than their market cap in cash, and we're going to talk a lot about that company. We're going to talk a lot about the risk with cash shells, capital allocation, and all that sort of stuff. Obviously, super small company, so please be sure to see the disclaimer at the end of this episode. But we're going to get to Doug and the pitch. But first, a word from our sponsors. This podcast is sponsored by FinTool. Look, those of you who have followed me on the blog, on the podcast, know that the two areas I've probably thought the most about over the past couple of months is AI and corporate governance. And look, if you are not using AI, you are getting left behind. And let me just marry those two thoughts in one way. If you read through proxies, there's one thing that you know. Proxies contain a lot of information, but they suck. Companies are almost intentionally obfuscating and burying a lot of the interesting information here. Guess what? You can use AI to really cut through the noise there. So FinTool just released a thing. You can go do a deep dive into every person in a company's executive roster. So, if I'm looking at a company, I can go to the FinTool people tool. I can look at their CFO and I can see, hey, here's exactly how much he's paid. Here's everything that he's done. Here's everything that's been included about him in the proxy for the past 5 years. Here's all those key incentives points summarized, laid out so that, what used to take me a day of going through 12 different proxies and looking and matching and saying, was he on this board? When did he join this board? It takes 15 seconds. So look, go check out FinTool, start using AI. You are going to get left behind fast if you are not using AI as a fundamental investor. FinTool, the really interesting product, and it continues to evolve. All right, hello and welcome to Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm happy to have on for the first time, the founder of Pitch the PM, Doug Garber. Doug, how's it going?
Good. Thanks for having me on, Andrew.
Look, I don't know how many times I've had a quote unquote rival podcast host on, but us small cap, us small value hosts got to stick together. Let me do this before we get started. Just disclaimer, I'll include a larger disclaimer at the end, but the company we're going to talk about today is Mammoth. The ticker there is TUSK. And I'll just remind everyone, this is a very small cap company, 125-ish million market cap. So that carries extra risk. And I just wanted to grab that extra disclaimer, go do your own work, not financial advice, all that up front. Anyway, Doug, the company we're talking about today is Mammoth Energy. The ticker is TUSK. What is it and why is it so interesting?
Well, I think it's a stock where there's very limited downside. But before we get into the stock, I think I should also say, as a disclosure, I do own the stock. I do want to be transparent about that. And I don't know if I view it as a competing podcast. I mean, I think we're both Louisiana Tulane guys, so I think we're all in this. Now I'm in my home office. In my other office, I actually have a Tulane banner right there, and it's the same theme of stocks under rocks. And I didn't want to really just do it on my own podcast and present it to myself. I thought it's such a more powerful dynamic when you're having the back and forth in the conversation with another really intelligent investor who can poke holes in your story. And I think that's the value that I see, and that's kind of why I wanted to do it with you, Andrew. So thanks for taking the time. And I know it's a small cap stock, and essentially I think the stock has been left for dead, right? It's about 118 million market cap today on May 21st, and it's a $2.45 stock. And it's been one, it was left for dead, and then it's recently done a transformation. So I've covered this stock since it did its IPO. The stock is owned 45% by Wexford. Originally, it was kind of a Northeast frack company for Gulfport, and then they also had their own sand. Those assets are very little value. They've kind of rode those up and rode those down. And then the other thing that happened, like last year was probably the worst year for natural gas. I think it was 221 was the average. It was like worst year ever. So they essentially went to almost no utilization for some months. So that, and they were reinvested in their fleet. But they've also been pretty entrepreneurial. If you know them, they've started some other industrial businesses from scratch. And there's been some other kind of oil service energy companies that have also had industrial assets that have been completely ignored. Now, not only is this company off the radar on the energy side, it's off the radar on the industrial side. It's small cap. It's really off the radar almost everywhere. I mean, Wexford owns it. I saw Adage. Then you get some index funds. So the reason it's interesting to me is actually they recently sold. There's two things that have happened. One is they got about $180 million from a settlement from PREPA, from Puerto Rico, for the work that they had done to restore the grid there after a hurricane. And essentially, the company was burning money before they had that money. They were doing their interest paid in kind. They had leased things out. They were in a tough financial position. And then they finally settled and got that money. And then I thought what they were going to do was pivot, and they have a transmission and distribution business, a segment of industrials that's been really essentially hot with the AI. I think a mini Quanta or Mazda. And I thought they were going to grow that business and just kind of leave the other businesses alone. And they announced, so first thing is they got that money, fixed the balance sheet. Then they announced the sale of the transmission and distribution business, which was essentially their biggest business. And they sold it for just under $110 million. Now, they had started that business 5-6 years ago for, I don't know, maybe $10 million and grown it. It was kind of a nice organic grow, and they got a 9x multiple on it because, the market, people like these sort of T&D assets, the recurring nature of the utility spend and the growth from kind of the AI. So now when they did that, they got even more cash. So now the company has called $155 million of cash. Now, $20 million of that is restricted until October. It's in a letter of credit tied up with the PREPA and the municipalities that should roll off in October, depending on what happens. But I feel pretty good they're going to get that $20 million there. But if you think, why is the stock priced the way it is? You would say, all right, I'm not going to give them credit for any of the money that is related to the Puerto Rico until it's in their bank account. That's what we've seen and been trained to do with this last, lawsuit that finally settled. So then you would say, all right, well, the company has $135 million of cash, market cap's $118. All right, about 87% of cash value. That's a good value, but that's not too unusual in small cap land, especially if you have a business that is cash flow negative. Now, last year they were cash flow negative, right? Their main business was natural gas energy. And they've been, I think last quarter they had positive 1 million of EBITDA, but still had negative cash flow with the CapEx. So that kind of that makes somewhat of sense, right? If you don't give them any credit for what is likely to happen in the future and their actual business lines. So they've got probably about another $40 to $50 million to collect. They've got $10 million escrow from the deal that they have recently finished. They have another 20 that we just talked about. That's a letter of credit that they should get in October related to the PREPA settlement. And then another 20, and this 20 is in their accounts receivable. And that 20 million, we don't really know the timing of when they'll get that, but they've agreed to that 20 million in their settlement, but it has to do with when the bondholders ultimately settle. And I don't know how long that will be. So I kind of discount that in my model. I call it 75, 80 cents on the dollar. There are markets out there to pull that forward because it's actually an administrative claim, which means it's not that risky. It's just the timing.
Dick, let me just pause you there. I think you've done a nice job going through all the stuff, but I think what it's coming down to is the stock, as we talk, is $250 per share ish, right? I think you just laid out a path to, even ignoring the businesses, approaching $3 per share in cash with another 50 cents to $1 per share of kind of cash-ish assets that should be, I don't even want to say on the come, but that should be coming through at some point. Am I laying that out about correctly?
Yeah, exactly. There's another, I call it about 90 cents of cash that should be coming on top of, the current 280. So
let me ask you the first question. I actually have some questions, but let me just frame it to you. I mean, the market is a really competitive place. Now we're getting into the much smaller cap lane, but the market can do math. What do you think the market what do you think you're seeing that the market is missing when it comes to making this kind of a risk adjusted alpha opportunity?
I think the market is giving Mammoth and TUSK credit for the current cash on the balance sheet, and they're not giving them credit for the next, call it 50 million that's supposed to come, 40 of it from the Puerto Rico and the 10 million that's in escrow. Unless they can see it in front of them, they're not giving them credit for that. So I think they're saying, all right, you have 135 of cash, I'll give you credit for that. But these businesses that, the appraised value might be about 145 million on top of it, they have negative cash flow last year. So I'm going to give you a discount to your cash because you're actually burning money. So I think that's what the market is saying, is looking at today. And I think there's, on top of that, I think there's the likely chance that the market's not giving them credit for is the future events of getting this 40 to 50 million dollars, which could be another, 87 cents a share is kind of how I discount it. And I understand why they're not giving them credit for it because, it's Puerto Rico, and we had the same issue when they were owed $360 million for years from PREPA, and they finally settled that and got 180 of it. They essentially got the principal and only a little bit of the interest. They didn't get all the interest.
Yep.
So the market's like, hey, I'm not going to give you credit for it until it's here. That's how I think the market thinks about it.
No, look, I think I think you're driving at that because I will say, like, I've got a lot of history with this stock, and I'm not the only one who, for years they were saying, hey, these are good claims on PREPA. We did good work. We're going to get it. And they were financing with PIK and everything. But if you go back to last year when they took the deal, it resulted in, like, from memory, well over $100 million of write-offs, right? Because they've been accruing all of that interest on the balance sheet. So I think the first thing people look at this and say, oh, cool, you've got the cash. And it's not lost on me that this company is kind of trading around cash, but getting hit with huge discounts on anything that's not cash. Because I think they look at the prior claims and say, oh, I don't know if I can trust that you're getting anywhere close to face value.
Yeah, I think that's exactly right. And if you dissect, one, it was the time to get the money from Puerto Rico, but this money has the kind of three tranches, right? There's the 10 million that's in escrow from the recent sale. We can say that's pretty safe. They might, normal dings on that after a year, closing adjustments, what have you. And then there's the LOC, which is already at a bank. So that money they should be getting back in October, unless somehow it gets extended and, they have to take some efforts to extend that LOC with the municipalities. So that money is actually, you feel pretty good about that coming in October. And then there's the next 20 million that's in AR where they had to take all these write-offs that they're owed this money. They've agreed to it. It's already been settled, and it's an administrative claim, which means it's higher up in the pecking order. But again, this is the same sort of thing as, that 360 is before, where I'm really not going to give you credit because I have no idea if it's going to come in 1, 2, or 7 years, right? So that last 20, you don't really know the timing. And I think just even that first 20 that's in the LOC, people just kind of say, well, that's too complicated. I'm not going to give them credit for it until it's here because it's still related. The Puerto Rican municipalities could fight it. And so I think they're not going to get credit for that until we've been trained from, not to give them credit until it's here because of what happened. And I think the bet is that, it's more likely than not that we're going to see most of that money in the next, in those three kind of increments.
I think the other thing that I want to say the market, but it's quite well. I've spent a lot of time on the busted biotechs recently, right? And these are biotechs that have $300 million in cash on the balance sheet, and they trade for $150 million in cash. And I think the two things the market looks at with those is, the main one, let's talk about the main one right now. The main one the market looks at is corporate governance risk, right? The market is really worried, like, hey, at these busted biotechs, the board doesn't own any stock, management doesn't own any stock, and I've called it a YOLO problem, right? Like, management can say, hey, we could return stock to shareholders, and then we put ourselves out of a job. We get nothing because we don't own any stock. Or we could take that $300 million and buy literal lottery tickets with it. And then if they hit, we're going to make a fortune. And if they lose, well, hey, we actually are better off because we collected another 3 years of salary. So, this is controlled. TUSK is controlled by Wexford. They own about 50% of the stock. So you don't have that misalignment problem that you might have at some of the busted biotechs. But that does carry other issues. I've certainly seen 50% shareholders create a lot of problems at their companies before. So I just want to toss it over to you. Like, what do you think about when you're buying a cash shell, you're relying on the corporate governance. So what do you kind of think about Wexford and what their plans for this cash are?
Yeah, so I that's kind of your risk, is that somehow they do something that's not favorable to the minority shareholders. That's always possible. I've known Wexford. They've been in and out of the public markets with IPOs, and at some point they kind of create companies, and then they have them go public, right? So if they do that, they'll lose their reputation and they won't be able to access the public markets in the future. I think they've had a long history accessing the public markets for IPOs and such. So I never say never, right? I don't, that's the risk here, is that something happens. I don't have a reason to believe that will be the case. It appears that everyone is aligned here. But yeah, you kind of essentially without a voice, and you're kind of hoping that Wexford acts in your self-interest and theirs, and everyone's aligned. Could they go private at a real cheap discount, and then you get a little bit and they get the rest? Yeah. I mean, that's always a possibility. In theory, there are fairness opinions that they pay a bank, so they kind of get whatever number you want there. When you're kind of pay to play on those fairness opinions, that's the risk, is that they decide to take this thing private at a discount to what I view the NAV at, at least 2x above it. But why would you do that? You have an asset, you have a public company asset, you've got all the controls, and it's, they can incubate things privately or buy them publicly. It's like another option for them, because they're a kind of a more diverse hedge fund private equity blend. But yeah, you're absolutely right. That's the risk here, is that you're not, you're on the outside. We're in the cheap seats where we sit. We don't, but like, again, I would just say, I don't go and think that's going to do something like that. I have known their reputation, and it's been solid.
Strange question here. They own, it's rounded up to 50% of the stock, right? Half the stock. I believe they have board members. Like the old CEO used to be a consultant to Wexford. They filed a 13G here, and I don't know of any, like, it's really rare for a company to file a 13G once they go over 20%. Like, almost every investment manager flips to a D once they go over 20%. How are they a 13G filer here? Is there less control than I'm thinking, or is there something else I'm missing here?
That's a great question. I actually don't have the answer to that. I mean, whether in terms of all the legalities, but they're essentially in control. I mean, I don't know if they have the majority of the seats on the board. I think they own 45, 46%, but my understanding is they're essentially calling the shots, right? The chairman of the board is the former GC, retired GC from Wexford. But I
that's just why I find it so strange that they've got a third street. Let me flip to a different question. Yeah. These capital allocation, right? Like, one of the tough things, and we can talk timing and everything, but one of the tough things when you buy something, $10 in cash, the stock's at $8. If you got that $10 next week, the IRR is insane, right? If you got that $10 10 years from now, your IRR is, you'd have been better having a bank account, basically. But here, Wexford controls 50%, so I'd hope for a rational capital allocation, but it's not lost on me. They just announced, I believe when they announced the deal, the deal to sell the deal they did just now to sell one of their divisions, they said, hey, we amended our revolver so that we can buy back shares and everything. But it's not lost on me that I think they announced the share buyback in August of 2023. They extended it again in 2024, and they've never executed on it. So I would pose to you, like, what do you think is the most likely outcome for this cash? Is it coming back to shareholders, or is it going to incubate and build new businesses, which can be fine, right? That could create value. But I look at that and I worry, like, hey, again, I know plenty of companies where there's a big controller, even if a rational, financially sophisticated controller like Wexford. I know plenty of companies where there's a big controller and they've sat on a big cash balance for 3, 4, 5 years because they were always looking for that big deal. They never hit. And then at the end, shareholders kind of look around and say, my $8 of, my $8.10 example, they look and say, oh, cool. we've generated a 1% IRR over the past 5 years as this company has just like held on to the cash balance, hoping for a grand slam. So I've kind of thrown a lot at you there, but I'd love to get your thoughts on kind of the cash and how likely it is something's done there.
Yeah. So yeah, I mean, there's a repurchase. Obviously, I would like them to do it because it's you're buying 50 cents on the dollar. I think it's a smart use of cash. I don't think companies this small with this limited float typically exercise the repurchase. There's a scale thing there. So I don't expect the money to come back to shareholders in that form or in a dividend. Um, I I think you've nailed it in that the key here is um, the time in and the use of the capital, right? They're going to have a lot of money to deploy. And the key is, I think, kind of continuing the shift away from the energy, the frack and the sand assets, and more towards the industrial businesses that are a little bit more stable, less cyclical. Now, the time's not necessarily right to exit the energy businesses. I mean, in fact, they actually just upgraded, spent, I think, was $12 million on tier 4 engines to kind of get their couple fleets competitive to get them working. So they didn't have to, they had something that they could offer. So that the market's like, all right, you're just investing back in frack. What has really changed here on the capital allocation that I know you're not just going to invest into a cyclical capital intensive business where there's not a lot of scale. Now, my conversations with management, they kind of know they don't have the scale at this point to compete in the frac business. I think they're just trying to, like when they did the T&D sale, they kind of made a point to say, hey, we exited this at 4 times tangible book. They're not looking to exit things at liquidation. They're looking to operate them and exit them at 2, 3, 4 times the asset thing. And they could be more patient. And again, like we have to go back to the natural gas market was the worst almost ever last year. And the actual outlook for the natural gas market, and I know the frac business and energy is obviously oil and gas. They're obviously much more levered to the gas market in the Northeast. Obviously, all the equipment has wheels. Most of it has wheels, and they can, but the gas outlook, we're doing 105, billion of BCF per day, or million BCF per day of demand. And there's talk, with more LNG exports and with AI data center demand, that could easily be 120, 130 is kind of what, the consensus is pointing to. I'd probably have to dig into that and haircut that. And that'd be pretty good and the other thing is most of the outlook for the gas market, this is kind of a closet play on gas too, because what's happened in the gas market is a lot of that incremental demand has been filled for free as the Permian and the oil basins have grown. So we had all this associated gas for free. There's even negative prices in the Permian, but the Permian is starting to slow down, not just because of prices, but they were slowing down before that just because of tier 1 acreage and interference. So you never really had the need you had free natural gas. Now, if you actually need to go back to drilling in the Haynesville and then the Northeast over the next handful of years, it's kind of a free call option on their energy assets and gas. And I think this time the company would actually exit if that happened. And what you're seeing is they started as an energy company, but they've got into all these infrastructure businesses, the transmission and distribution. Obviously, they got into Puerto Rico, which was a huge headache. But what's left in the infrastructure and the industrial businesses, and these businesses are more stable, kind of, you think 8 to 10 times EBITDA, steady, less cyclical, kind of steady ROAs, low double digits. They have an engineering business, which think like a Jacobs, like a higher margin professional services business in there that they did kind of from scratch. They built. They have another business that they still have that's similar to transmission and distribution. It's a fiber business, like think Dycom I guess Quanta and Mosstock have those businesses as well. So those are little businesses they're slowly incubating. And then the way I think about this is you're buying into a private equity fund with no 2 and 20 at 50 cents on the dollar. But yes, you are trusting Wexford to do the capital allocation to exit energy in a couple of years and find good industrial deals or something else. But I think they'll hopefully stick to industrial. Like they're investing in rentals, which they are rental, telehandlers and cranes, but that equipment is going somewhat to the to the oil patch, but it is industrial equipment that they're going to start doing construction with too to kind of build that out. So it's like a little tiny URI, right? And then I think they just did this. They've done two capital allocation things in the last 6 months, other than the divestment. One I like. They did a sale, essentially bought aircraft, 11.5 million of aircraft, and kind of bought them with leases. So it's not destroying capital. That's a solid. That'll probably add, call it $1 million, call it 10% return. You can put some leverage on that if you want. And, it's not the best business in the world like software, but it's probably a solid use of cash. And if they grew the rental part of the business, I think that'd be good. Now, the other thing they did that I personally didn't think was great, it was kind of counter-cyclical, is when they got the money last year from the Puerto Rico settlement, they decided to pour some of that into, upgrading their frack equipment. And it's like putting good money after bad. Now, I get it. It's counter-cyclical. You don't want to just shut down the business. You want to get it marketed and going so you can sell it for more than equipment value. And they already had the customers and the people, and it's kind of a sunk cost. So they did do that. I think when they did that, I wasn't excited to see that last year as an announcement. But I think it's such a smaller part of the story now with the sale of the T&D business. And like you said,
so you went through a lot of the different segments, right? And you talked about, hey, how the outlook, a lot of the segments are kind of like down on their luck, how the outlook, with cyclical businesses, you generally want to buy them when they're down. And I definitely hear that. But most of the segments you listed, like, I don't know, you mentioned their engineering segment and said, hey, you've got a mini Jacobs.
Tight.
I've seen this company's financials for a while. It's hard for me to look at this and say, hey, there's a mini Jacobs in here. Or, you mentioned, if I remember correctly, like drilling services, right? Even in 2022, it's basically adjusted EBITDA break even. It's like, hey, they're redoing, I don't know, all these businesses. Now, this can still work without these businesses needing to be Jacobs, right? Like we're buying below cash. But if you had asked me before they sold infrastructure services this year, what the sum total of all these investments have done, I would have said, hey, they're investing $1 and turning it into 70 cents. And selling the infrastructure services is a big mark in their favor, right? Like they sold it for a multiple book value. I think book value was a little depressed, but they probably got a good return on that. But I still look at these businesses, I'm like, look, these look pretty commodity to me. And I have trouble believing that any dollar in here is going to produce any economic profits, if that makes sense, right? I'm not saying it's turning $1 to 70 cents, but it's hard for me to see how they're turning $1 to $1. And again, coming back to the original point, hey, you're buying a lot of this cash. If it's going to get invested to growing these businesses and it's $1 is going to turn into $1, well, over time, your IRR just keeps ticking down. So what do you think about that?
I mean, I think it's a very valid point. And historically, the big driver here has been the frack business and the sand business. And, the sand business was a Northern White business that completely got priced out by the local sand. They're selling a little bit into Canada because they happen to be on the CP, but that business is not, it's worth a couple percent of what it was initially. So that business has essentially been wiped out. I'm giving it $1 million of value in my NAV, $500,000 of EBITDA 2 times. And then the frack business, again, I'm only giving them credit at, $8 million of EBITDA 2.5 times, but that could be 0. That could be 20 to 30 if the cycle actually picks up. But right now, there's no indication of that. It's just getting a little better. But the capital allocation based on what they did in history, and if they were going to invest in frack, I agree, $1 is going to be 70 cents, or profit, $1 becomes 2 cents. I'm pretty sure they're not going towards the energy is not the driver anymore, right? They built these infrastructure businesses, all these other segments in industrial within infrastructure, and they're doing more of that as their strategy in the rental business to get that more towards construction, towards aircraft. So you're right. That's why I was annoyed when I don't want to say annoyed, but it's not my choice. They have a longer time horizon. I'm not in the boardroom, but when they started to reinvest in the frac business. But I guess you don't want to shut it down. They have more patience. They're longer term, right? We tend to be a year. They say, all right, we'll just wait till the cycle tends to pick up at some point when we're short this equipment. Usually have, 1 or 2 good years out of every 5 in the frac world. And if they invest in frac, I agree. I wouldn't want to do this, but I don't believe they're going to do that. I think they're going to get it going and punt it and hopefully invest in more like aircraft and other industrial businesses. But that's the key, is doing a pipeline. And a lot of that pipeline probably comes from Wexford. And like, do we do it privately? Do we do it in TUSK? So I don't really know that dynamic, but that's exactly right. I feel like an aircraft lease business, get 10% return.
Let me pause you there, because the aircraft is now, anybody who's followed small public companies before can point to a dozen companies that they announce an aircraft purchase, and what it is they bought a small private jet for their CEO to fly around on the company's dime, right? So this is not that. They bought, I believe it's eight small passenger aircrafts for $11.5 or $12 million, right? And this was in April. So this is kind of using 10% of the proceeds of the infrastructure business they just sold, let's say. I don't know the business well enough to know it one way or another, but I was surprised, right? Like, this is a very small company with not a lot of people following it. And when I said, hey, I'm going to be doing a podcast on TUSK, I had 3 different people reach out and say, ask them about the aircraft. People were really upset about the aircraft. Now, I think these are smart shareholders. I don't think they think like they bought a PJ or something, but maybe they did. But, it is another thing where you buy aircraft. These are literal commodities. You buy them for $11.5 million. I look at that and say, hey, a business that I'm not sure if it's earning its cost of capital, you're throwing $11.5 million in aircraft. I can kind of get the concern. It sounds like you're pretty bullish on the aircraft purchase, so I'd love to just discuss that real quick.
Well, I wouldn't say I'm bullish. Relative to reinvesting in frac, yeah, I think they're more likely, because it came with contracts, to get a return on capital there with contracts that actually adds free cash flow to the P&L, and it's not energy, it is industrially. So if I had to, think about it, energy is cyclical, so you got to time it right. I'd kind of put those in the kind of letter C category. I'd put some industrial businesses, these are more, in the B-ish category. And then you look at some amazing businesses, whether it's, a software or a capital light business, professional services, those would be more in the A category. So they are still moving up from the C to the B, but it also has to do with their partners at Wexford and where they're seeing their deal flow. In my conversations, I'm with the management team, they are more focused on the rental segment, which is called a URI. You call that stuff commoditized, but you're providing a service, right? It's telehandlers, cranes, stuff like that. That's okay business. It's not, Apple, but it's fine. It's solid. If it's run nicely, run well. And you also, I think you have to look at, we generally talk about the P&L over the years, which was this Puerto Rico disaster and the frac cyclicality. And we don't really talk about the T&D business that actually was a good returner, the tiny engineering business or the fiber or the rental. Those businesses are now, they're tiny, but like they're now actually, they could be more meaningful if they put the capital into those businesses. So I kind of think of this as like it's a little private equity. They're incubating little companies, and they have a couple choices. They have a handful of choices in the industrial world. The energy world, they kind of doing one more hurrah, kind of invest, get it running, get the customers, get it flowing, and then hopefully exit to someone who has more scale, and it becomes an industrial company. So you have to believe that they can execute on that vision to become an industrial, someone who can consistently grow a solid industrial business and allocate capital in a way that is accretive to earnings. It's kind of like a blank slate right now.
No, that's what makes it a little hard to talk about, right? It's like, hey, the stock trading at $250 with $3 per share in cash. Like, you can talk about everything till the cows come home, but ultimately it's like, what is the cash? What gets done with it? But speaking of what gets done with the cash, the company has a strange setup, right? So their CEO is going with the infrastructure assets that they sold. So he's going over there, but he's also staying on the company as the interim C. He's staying on Mammoth as the interim CEO while they try to find his replacement. So he's running the other assets, but he's interim CEO here. That's a very strange setup. Now, this is a small company. I understand that, but it's a very strange setup. So I guess what I'm saying, like, what do the next big catalyst here is probably going to be a CEO announcement and a CEO saying, like, hey, Excited's coming here. Here's what I think I'm going to do with this $150 million cash pile that this company sit on. What are you kind of looking for? What are you looking for in the next CEO? Like, is it going to be an operating guy? Are they going to announce, hey, we've got a 38-year-old former private equity guy who's coming in? He's going to actually turn this into a mini private equity firm. He's not an operator at all. Like, what? How do you think about that?
Yeah, I mean, that is essentially the next key catalyst is who is the next CEO and what is their vision. When I met with Phil, who was essentially the head of the T&D business, the utility, I'm like, all right, they're going to grow this into like a baby little quanta, right? Because that's the business they're focused on. That's the steadiest part. Makes sense that he would go with them. They probably wanted it. The fact that he's staying on, it's a little unusual, but he's just staying on until July, right? Gives them a couple, whatever it is, 90 days to find someone that they're doing a search, right? The board is. I don't know who is going to be announced. It's hopefully, I don't think it'll be an operational guy. I think the reason it was an operational guy is because that was the biggest segment. I don't think it would be one of these segments, right? These aren't necessarily big enough to say you're going to run the company, you're going to be in charge. So hopefully it is someone who has more of that, because the key debate, like you said, is deal flow and execution on deploying this capital at a decent pace. And that is the key. So hopefully it is someone that has more of a kind of a funnel, and more of a private equity deal flow person, or you're just a capital allocator, I think would be really good. Someone who's savvy with investments. I've known the CFO, Mark, for a long time. I actually think he knows all the businesses. He thinks about it properly from a, capital allocation and strategy perspective. Now the key obviously for the CEO is the ability to source and execute deals. So that is, that's what the board's looking at for now. So they probably have a bunch of people. I don't know what's in the Wexford stable as well. But essentially I think they're probably looking, internally and whatnot. But yeah, that'll be the key, given confidence that we could deploy this money.
Yeah. No, I would just say, having followed it for a long time, and like I'm just kind of flipping through my notes, I will tell you, like, the one thing that they sold infrastructure service for a nice figure, but the one thing that really, yeah, I'm looking at the old ad backs and infrastructure service. They kept accruing the interest on the PREPA loans and reporting it in their adjusted EBITDA, and then they wrote all of that off in 2024, and it just kind of left a bad taste in my mouth that they, look, I know tons of friends, and I had some stock too, who you invest in this and you're like, rational capital allocation, buying at a discount. It was tangible book, not cash at that point. Buying a discount, eventually collect from PREPA, and then they took such a huge haircut and write down. It was like, oh, it was just kind of disappointing. It kind of left a bad taste in my mouth. But that history is neither here nor there, except to the point you kind of question the operators here, I guess.
Yeah, I mean that was yeah, obviously they got about 50 cents on the dollar, the 180 out of the 360. And I think their actual service amount they were owed was 145. So they got a little bit of the interest. So, if you're arguing that you're owed it all in a court, you still have to, accountant wise, it's just accounting. You have to keep accruing it because you're owed it via the contract until you're not. So I don't think I ever expected them to get the interest. I was surprised they even got the 45, or I don't remember if I had I thought maybe they get 65% of the total 360. I don't remember what I used to have in my model. I never expected them to get the whole thing. And just that, again, the interest, I think they'd be happy enough just to get what they were owed at a Puerto Rico, and they got a little bit more. But my disappointment was going back into the frack business after that. And then also I think they had some more like sale leasebacks and other things that I didn't realize that they had to use the proceeds for, that, they were really, running things leanly and thin because they were liquidity strapped for a while without that money. And yeah, so I think you nailed it. It's the getting confidence in the capital allocation and the running of it from going forward, and shift into higher quality businesses and getting that deal flow.
Yeah. No, I can't remember who I'm just looking through it. I can't remember who the CEO was, but I looked through all my notes on the old earnings calls, and they were like, look, these are FEMA obligates PREPA. FEMA's on the hook for it. They used to tout. I've got something from the Q4 22 call where they're like, hey, we've got 650 per share owed from us from PREPA, and we're working hard to collect all that money. It's just,
Yep, yep.
I definitely hear you, but at the same time, like I do.
Yeah.
I don't know. I don't know. Do you think Wexford's been happy with this investment so far?
Well, I'm not sure exactly when Wexford has exited, and this thing used to be in the 30s when and then Gulfport owned it. So I don't know how much they exited at what price when they initially IPO'd it. So I haven't run the math, right? Originally when they IPO'd it was at a multiple of the assets, and since then, obviously the two core businesses, the frack business and the sand business, have really devalued. So I don't know how they would be happy. The stock's, it's at a couple bucks, and before, I think when it started, it was in the 20s or 30s. So I can't imagine they're actually happy with it. I think that's a sunk cost, and now it's about how do we deploy this capital to value, because it's, you've got call it 280 of cash on the balance sheet, 280 per share. Then you've got another 87 cents in my value of cash that you're going to get. I actually believe the business is about free cash flow neutral right now, as long as the frac business is doing 1.5 fleets, because you get a little interest income. And that's something different than the last year or two. So then they actually did an appraisal last year, and it was about 190 million less 45 for the assets they sold. So there's another $3 in appraised, call it steel value of assets. Now, I don't get there to some of the parts. I get to about half of that. So you're dealing with, if you literally just liquidated this entire company, you could get close to $657. Now, I don't think they're going to sell their assets. They're going to try and operate them and have create an entity out of it, and it'll be part of the, Wexford has hedge funds in there. They've got all sorts of other vehicles. So I think this will be part of their stable. But that is the X factor. What is Wexford going to do, and how are they going to allocate capital? And those are both things, as someone on the outside, we don't know that until they have a CEO.
I'm glad you mentioned the appraised value, because that is like, and again, this is not unique to Wexford. It happens a lot of times with these small cap companies, but it's kind of the curse of the small cap company, right? You say, hey, I value these businesses at 100 million. The appraised value is 200 million, right? So, and then we're buying them, as we've talked about, we're buying the company for like below its net cash. So you get the business on top. Like, that's a really nice, very Ben Graham style setup. I'm rereading the Snowball. Like, that's the type of setup Ben Graham would love. But then your counter is, hey, they invested in two businesses. The appraised value is 200 million because they invested 200 million into it, and it's worth 100 million in our valuation now, right? So you're like, hey, maybe it's trading below net cash because they've got businesses with appraised value that they're operating, and we think they're worth 100 million. And that's like literally the definition of turning a dollar into 50 cents, right? So I've got one more thing, but I don't know if you have anything to add on that.
I mean, that was there historically in the frac business. That's what you expect, because that's a business, unless you time it right, or you're a premier operator like a Liberty or a Halliburton, most people don't really earn their stripes in that business. I would say I do want to differentiate a little bit, right? Because I have like a sum of the parts of the current businesses at worth about 73 million. And then the appraised value is not the book value, right? The book value is separate. The appraised value, they got an appraiser, a range, come in and do this at year end. And this is what they think, the assets a bank would underwrite and what they could sell to. So it's, it's only worth that if they sell it. And there are some things in there like drilling rigs, right? They've got some old, I don't know, 10, 12, 15 drilling rigs with walk-in systems. They could sell those internationally. They're not really making any money. And you alluded to this, that business wasn't really making money for them. Those rigs could go internationally. There could be 10 million of cash that they can unlock that no one's giving them credit for. So there are some things. Now you're right. They did spend money on that, and there's a higher, that it's a loss, but it's still not generating cash. Could be worth something if they do sell it at some point internationally. But yeah, I mean, appraised value is, it's doesn't count unless you're generating cash from it. So
The other thing I like here is, look, again, I don't know. I think Wexford's got a lot of funds. I don't know anything about them or talk to them, but you can look at their 13F, and Mammoth TUSK is their largest holding on their 13F. And again, it could be, the 10th largest holding across 100 different funds, and that's it. But there should be some institutional imperative to try to make the best of this investment. Doesn't mean it works out well or not, right? But like, you should have a like, I've seen people with huge alignment, tons of stock, and the stock goes to zero for whichever reason. But here you've got a bunch of cash and a kind of control shareholder who should be aligned. Like, you 98 times out of 100, it's hard to think of a disaster scenario with that setup.
yeah, I mean, I think one of the big differences now when I'm investing is I think a lot more about downside protection, margin of safety, and not losing money. So it's like, how do I lose in this one? I don't really see, it's kind of an asymmetric risk reward. How do I lose? All right, they invest in things and they go to 50 cents on the dollar, or they, buy it out at, a tiny premium. There's just a lot of margin of safety when you're buying it below cash, and then they're getting more cash than you have the businesses that they're not getting credit for. So I think I see, how much downside? I don't really see any. And then you could see, if everything goes right, it could easily be, a $7 stock.
I'm just laughing to myself because that's the thesis for the shitty biotechs trading at half cash I have, except in all of them, I say, how do I lose? I'm like, oh, I know. The management teams, they really enjoy taking a flamethrower to their cash balance and just like lighting it all on fire for whatever reason.
Yeah, the question is it shareholders? Is it their cash, or is it shareholders' cash? This is actually literally half the dollars, or they're theirs, right? They could.
Yeah.
The question for them is, do you take this thing private, or do you keep a public vehicle, even though it's discounted, and build something? I just think of it as a private equity in the public market, with no fees and at a discount. So it's like buying into private equity at 50 cents on the dollar with no 2 and 20. It sounds, yeah. And no 100-page deck that you never end up reading, with disclosure and management changes that you get and can't log into whatever portal you have, right? You can actually, and I like that transformation, hopefully from energy to industrial, but
Cool. I think we've covered, I mean, I know we've covered all of my notes. Any party thoughts or anything you think we should talk about?
No, I mean, I think you've kind of nailed it, kind of why it's at a discount, and why the history was kind of choppy, and the lack of credibility from Puerto Rico, and the returns, and the importance of the capital allocation forward. And that's really the most important factor, is something that's not even on the table yet.
On Puerto Rico, it's funny. When I started, there were so many Puerto Rico investments. There was all the bond insurers had huge exposure to, the MBIs and AMBACs of the world had huge exposure to Puerto Rico. There's Liberty Lilac. There was this. I'm trying to think of a few others. I think the Puerto Rican bank, actually, Banco Popular, actually has worked out well. It is kind of the exception that proves the rule. But in general, like, if there's, in my history, if you had been like, hey, this investment touches Puerto Rico, it would have been better for me to just like go, I don't know, drink a fifth of bourbon and take a nap at 2 p.m. in the afternoon instead of even spending any time, because the brain damage on all of them has just been enormous, and almost all of them have gone just straight down. Again, maybe with the exception of Banco Popular, but this is another one. And again, I think people can hear, like, for years it was, hey, we had these AR, the interest is accruing, FEMA backs them, FEMA's pushing them, like, we're going to get it. Just everything Puerto Rico. It's just so crazy. It is the place where stock market capital goes to die.
Yeah, there. And, I think that was Puerto Rico and the frack. They had so much hair on them. No one was touching it. And
Yeah,
now,
that's a great point. Between Puerto Rico and fracking, I mean, my
yeah,
God, what a combo.
like, so they had a lot of, hair. And I think that's behind them now. And now it's kind of almost a clean slate. They still have to exit some stuff, and they've got some steel in the closet, and they've got to allocate it. So yeah, it's the trust that the management and the board are going to allocate that capital um, in a way that's good. I mean, so far, in my opinion, it's been okay. I wasn't crazy about the frack. I like aircraft was okay, but they got to show that. So yeah, that's kind of where I am on. It's kind of limited doubt.
Perfect.
That's what I look for these days.
Well, let's wrap it up there. Doug Garber, Pitch the PM. I'm laughing because a lot of the Pitch the PM stuff has been NVIDIA focused, and I was going to say next to everybody, but I don't even know how I could do a podcast on NVIDIA, to be honest with you.
Go with the largest, most popular stock versus the smallest stock that no one's ever heard of. And it's funny when you think about the podcast episodes, like I'm usually looking for things that no one's ever heard of. The stuff you're going to invest in isn't on TV, but I'm like, well, NVIDIA is kind of priced for perfection, high expectations, but you still want to have kind of talk about large relevant companies as well. Now, I've just been digging into that one for like a year. I wasn't a semi guy to begin with, but kind of going on to kind of deep value now.
No, I wasn't a semi guy though. I do think all the time it was 2022. Somebody said, "Hey, the time you'll know AI is really here is when NVIDIA stock just keeps going up, and all of your smart techno friends just keep buying calls option, and it goes up and up and up." And I heard that, and NVIDIA stock started going up and up and up, and I was like, "Oh, I think AI might be here. Maybe I should just do it and buy some call options on it." And my God, would that have been a good decision? But I was like, I'm not a semiconductor. I don't need to do the speculation. I should have just shut up, Andrew. Go do it. Anyway, Doug Garber, Pitch the PM. This has been great. We'll chat soon.
All right, thanks. Bye.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.